Welcome to TMS Insights. It's the middle of October and there has been a frenetic amount of activity been in all markets around the world in different parts, and things have probably had a bit of change, but another change is you on the other side of this desk right now.
It feels a bit strange, but it's good to mix things up.
13 years of doing TMS Insights this way. You sprung it on me this morning, so very good. But tell me about markets. I mean, the real theme, and we had another good September quarter for markets. ASX was up about 4%, which is a big quarter, of its own. Yeah. But talk about commodities really dominating the thematics, and comments from the Federal Reserve, of course. So let's get across all those things. From the top, let's talk about commodities.
Yeah. Commodities are pretty interesting because they've been in the doldrums for 2 to 3 years now. There's been a very skeptical, uncertain view on China, which is the main customer of these metals, and whichever ones you pretty much look at. And I think it's almost like the perfect storm, Jez, where you've got institutional ownership has been very low. They haven't seen any real reason. Underowned.
Yeah.
So that's number one. Short interest, very high.
So hedge funds.
There's been a lot of big short positions in a lot of commodity stocks. And then we've seen, and really what led it was the iron ore price, which was falling. It looked like under $90 at the start of this year. It's back at 106, and we've seen the copper price, the gold price, of course, has been on fire, the silver price, and we've seen this AI boom in America has driven this urgency and the defense issues around the world from Trump to secure critical minerals, which has led to this almost short covering, institutionals getting back to market weight, and a lot of speculative behavior, I'd say. So we're seeing capital raisings happen nearly every day, floats happening nearly every day. It feels very frothy, but as we know with resources,
it goes on for a while.
It can go on for a lot longer than you expect.
Yeah, generally speaking, does. Tell us what I mean. So there's precious metals, which are doing one thing. There's industrial metals and bulk commodities, and they're telling us something about the economy. But what's going on in remarkably cryptocurrency and precious metals? Let's talk about gold and Bitcoin. They're running hot now. This is part of a bigger thing about de-dollarization, isn't it?
Yes, it is, and I think somewhat of a loss of trust in governments and central banks. I think
particularly the hegemon of the US.
Yes, but I also feel like there's a monthly Bank of America Merrill Lynch survey which comes out. It's the biggest fund manager survey globally, and when the response was, what's the most overowned area of the markets at the moment, it was gold. And I think there's this view that you need to be a part of it, and there's almost like this FOMO sort of thing that's starting to occur. When you look at gold equities in Australia, we went to Livewire Live, and one of the L1 fund manager who's been very good in this area said, if you look at the market capitalization of most Australian gold stocks, the gold price actually needs to go higher from here for it to make any sense to own them, because you've got most gold mines are relatively short mine life. The costs are quite high. It's not like iron ore, which is 50-60 year mines at very low cost of production. And so he sort of said you almost need like a $4,500 gold price just to warrant paying the current market caps.
And so the obvious question then, just to go into this a bit and say, well, because somebody would ask, why don't you have gold here? Or it's the same question, strangely, about why you wouldn't have Bitcoin for me, which is really, there is a lot to do in the industrial space where you've got cash flows you understand, you've got industrial companies, but think about industrial commodities that have real businesses.
Yes.
And that you're not just supply demand dependent. So and this is probably to get us back into an area that is more in our zone, which is investing in productive companies, either here or around the world. So in pivoting away from commodities to get an understanding of what's going on elsewhere, let's talk other thematics, because we do also acknowledge this. There hasn't been a lot of stock specific things in the market. There's been macro stuff. So let's talk. What can we tell people about the latest in the AI boom? Because that's obviously been continuing to be a massive thematic.
It's the news that is coming out of America on a daily basis. It almost feels like a wartime footing that we're seeing.
Yeah.
In terms of, OpenAI just announced a deal with Broadcom a couple of nights ago. There's deals
after the AMD deal,
and
the Nvidia deal, and
yeah, $100 billion US spend. This is what's really pushing the US market. Is we're seeing they're big companies are investing at a almost once in a lifetime sort of scale and speed, and that's filtering down into a lot of different industries. And rare earths will be an area in Australia that's filtering through to. And there's this demand for data centers. So in the US, the big question mark that everyone has got is, what are the returns on this capital spend going to look like?
Now.
They're terrible now. And we know they won't be terrible in the future, but how good will they be?
And the land grab that it represents may not pay off entirely. So this is where you've got to keep a bit of a level head and not get too carried away, because we're not going to absolutely know the answer.
Well, no one knows.
It's changing the world. Nobody can know. But it's changing the world, and there's big opportunities. You can play it without betting the whole house on it.
Yes.
That's the best way to do it. And we've talked to clients about that. Into the macro, because Jerome Powell again spoke last week. And Ben, the direction for rates still looks comfortable for us.
Yeah, it does. So the rate outlook looks about as good as you could want it, which is one of the reasons the US market is at pretty much an all-time high. Just a very mild cutting bias from the central bank, and that's kind of nirvana for the share market in terms of its outlook. And the economy, I think, is still holding up there very well. And globally, economies are still kicking along pretty well. We've got Europe's doing okay. Japan's doing quite well.
It's the breadth of the global economy that we weren't seeing, a year or two ago. So that's good. And in terms of earnings and how that filters down, we are a pretty quiet time for earnings in Australia after the August reporting season. We do come into banks here in November, start of November. We are getting US reporting. Their banks have been reporting well.
Yes.
Very well.
And
we'll hear from their big techs and all those other players through the course of the next month. But with interest rates in a good spot and earnings looking good, Ben, it is a good part to be invested at the moment.
Oh, well, the outlook looks pretty good to me. The Australian market is a difficult one, because what it feels like is happening to me is money is getting, as these fund managers are reweighting to resources, they need to sell something else to fund that. They're selling growth stocks. They're selling different parts of the market, not because there's an issue.
There's value in some of these growth.
I absolutely think so. I think that's where the value is. There's a lot of businesses which reported well in August, and there's been no change in the outlooks, but the share prices have come back because fund managers are rotating to chase resources, and they need to do that.
And they'll rotate back at some
point, as we all know.
It's just that cycle that we play, and we see time and time again.
Absolutely.
So all good.
Tax change, super.
Yeah, really important for everybody. There's so much noise in financial markets and in the local economy. One of the things that's really confused a lot of people, even if that didn't apply to them, Ben, is the proposed changes to super, which we learnt this week. The government is now tabling legislation which has radically reduced some of the more offensive parts of the proposed legislation, which is good news.
It's great news. Common sense has prevailed. We will have a handful of clients who will still be affected by a new tax bracket that's coming in, but it's at a very significant level. But I think Albo saw the writing on the wall that he didn't want to go down another franking credit battle, and I think it was just some of the.
It's sensible as well.
Sensible.
So not taxing unrealised gains. It is obviously good tax policy.
Indexing is
good tax policy. These things are good. But there is a salient point for everybody. There were people talking publicly about making all your changes to your assets, including super, ahead of any proposed changes.
And people did, some people droves.
But that's not been rewarded, because the changes that were talked about aren't coming in, and let's just wait for the legislation to be tabled and given royal assent, because that's the time when you can.
Plan
What we
around.
do know is 1 July 26 is when they're going to come in.
Yes,
So,
which will mean that these tests will be enacted at 30 June 2027.
That's
So we now have
time.
a significant amount of
Yeah.
time for those
Yeah.
clients that are in that area
That's it.
to plan toward it.
That's it.
But I've got to say, there was some terrible advice being thrown around, knee-jerk reactions,
Absolutely.
which is going to cost people
Yes, it will.
millions of
It will.
dollars over their lifetimes if
And
they
the
act on it.
messaging here is super is still the most attractive thing you can do,
Yeah.
and maximise it while you can.
Mm.
And any changes you did to lessen that would be regretted. So
Yeah,
we
yeah.
certainly wanted you to wait and did do, and so we'll continue to watch as that
Yeah.
unfolds. But some good news there.
Yeah, definitely.
Great. We'll be back with another Insights in November.